But Dhiraj Sachdev from Roha Ventures now joins us to discuss market fundamentals as well as its top sectoral picks. Thank you so much, Dhiraj, for joining us. First up, how have you viewed the last 2 weeks, especially in terms of the amount of news flow, so many tariff tantrums coming about. So eventually, what are you penciling as far as Q4 earnings is concerned, and what kind of impact do you see from tariffs?
Yeah, hi, good morning. I see the equity market over the last 2 weeks has been calm and after a roller coaster ride led by tariff tantrum. The 90-day window of pause on tariffs is creating a hope of a faster bilateral agreement between several countries, including India with the US, to avoid any high reciprocal tariffs from US. Now, importantly, India's modest exposure to the US and its resilient consumption-led economy provides some comfort. Now, what will eventually happen to global supply chain will definitely be shifted in many products, and India can be one of those beneficiaries by gaining market share from China in a few sectors, giving India exports a relative advantage. So we have seen India's share in global supply chains rising, aided by PLI schemes. For example, Apple's iPhone export has risen from $3 to $20 billion in past 4 years alone. Similarly, several sectors such as pharma and specialty chemicals have a strong case for cost competitiveness in global supply chain realignment. So, of course, one has to evaluate how China reacts, whether by raising prices of key materials or dumping its excess capacity or rerouting exports to US via other countries. So coming back to India, I think domestic consumption trends are improving, supported by higher retail spending, quick commerce, rural revival, and supportive fiscal and monetary measures like tax reliefs have been given. There's been lower interest rates expected to be almost 75 to 100 basis points going forward. And also the capex cycle is expected to revive, driven by infrastructure or PLI schemes and green energy initiatives. Now, also one change in stance that has happened is RBI's liquidity measures and potential interest rate cuts further add to this positive outlook. So government spending on welfare schemes, tax cuts, rural demand recovery should aid economic activity as far as our country is concerned. So overall, we remain constructive on Indian market, which is likely to consolidate for some time rather than see any deeper correction. And what can eventually happen after this 90-day pause is also that Indian markets can surprise on the upside.
Dhiraj, while you've largely held on to this view, even, I remember the last conversation or the prior one, that you like the consumption story, you like financials, PLI, etc. But, things are changing so rapidly. The macros have been overturned, narratives have changed, prices are getting reset, valuations are getting reset. Any shift in the way you think about individual themes in the last 1 month? Any portfolio churn that you have done? Just talking about the change, the change from last month to this month.
No, Reema, I think if you see, these are all still domestic-centric opportunities that we are talking about. See, financials obviously will benefit out of rate-cutting cycle. A lot of provisions have been upfronted. Though the disbursement levels will be lower, but I think financials is in a sweet spot as far as growth and value spectrum is concerned. Similarly, consumption theme, we talked about several things about tax reliefs to driving rural consumption demand going forward, better monsoon forecast, etc. So financials, consumption, real estate, cement, renewables, CDMO, hospital companies in pharma, healthcare, and staffing businesses are mostly domestic-centric and driven by that demand environment. Even if you see quick commerce and premiumizations are also strong consumer trends, benefiting segments like auto retail, alcoholic beverages, and QSRs. So we have not really changed the stance materially, except for metals and consumer staples where we are avoiding, there is no change in the stance.
Understood that. Dhiraj, the other question that we have is, we understand that you like quite a few domestic facing names. But especially when it comes to some of the export-oriented sectors, there's been significant volatility in some of these names, especially if you look at the auto pack, names like Tata Motors, some of the auto ancillaries like Bharat Forge, Sona, Comstar, Motherson. Given the kind of volatility, given the kind of correction, do you think now is a good time to go ahead and add into these names, or would you stay away and wait for more clarity?
Question autos specifically, I think even in domestic, the last few months sales data is disappointing with muted growth both in passenger cars and two-wheelers. We do expect some support from a potential decline in interest rates and better rural demand. Now, what is happening in autos is premium segments such as SUVs or greater than 125cc bikes and EVs are expected to grow faster. And we expect strong growth in EV segment as far as the penetration is concerned. I mean, that can rise to almost 4% for passenger cars and almost 8% to two-wheelers as far as EVs penetration is concerned. Now, the OEMs may still face issues on the export side, as you rightly mentioned, including tire companies, which are expected to get impacted by lower demand. CV cycle, even domestically, is showing a modest growth. So we are still evaluating and avoiding export plays on the auto side specifically, and evaluating ideas in the auto ancillary segment, which will benefit from rising EV penetration. I mean, that's the sweet spot that we are trying to hunt.
Understood that. Also, pharma is the other space, pharma, healthcare. Now, within pharma and healthcare, where does your preference lie? Does it lie towards export-facing generic makers? Do you like CDMO companies? Or would you play domestic healthcare companies or even hospitals for that matter?
I think you've already narrated a fairly differentiated heterogeneous segment in pharma and healthcare. See, Indian pharma industry supplies 30 to 35% of US generics, and drug shortages in the US are higher than what it was 2 years ago. Chinese pharma exports to the US will become costlier post tariffs, if any, on pharma, and that will create opportunities for Indian players to be competitive. Besides, Indian companies are set to gain from the continuing benefits of specialty products, as well as stable pricing scenario in the US generics market. So in addition, steady growth in domestic formulations will aid earnings growth. So we like select companies in API, CDMO segments, a mix of formulation in the domestic market, including some of the export companies, which will benefit out of cost competence. So it's a very heterogeneous selective play that we like in pharma. There is nothing that differentiates between domestic and exports.
While there is no growth for IT and growth is severely lagging, valuations are now getting into, I don't know if you'd call it attractive, but in the case of, say, Infy and TCS, it's pretty much lower than the long-term average. Wipro is almost getting there, close to about 18 times forward valuation multiple, which is its 10-year average. At what point does one start looking at IT?
The right observation, Reema. I think valuations have corrected. Even large caps are at 18 to 20 times up, when you look at the earnings. But the problem with top large IT companies have reported muted sequential revenue growth in the recent quarter with not so impressive guidance. On top of it, going forward, the sector is currently facing uncertainty from US spending. I mean, recent results do indicate that US clients in manufacturing or retail are postponing technology spending. And besides, large deals bring competition amongst IT service firms that typically squeezes margins. So the demand recovery pace is going to be gradual and depends upon certainty on US tariffs. I mean, BFSI and travel verticals hold promise for any improvement in the technology spending. Now, structurally, of course, long term, we believe one can play positively because clients are prioritizing critical initiatives like digital, cloud, and data. And there is a possible profit pool expansion happening due to AI. Though valuations have corrected in the near term, there is still a weak outlook at the headline level. So, of course, over the next couple of months, there'll be more clarity when one can wait for some time in the near term. And then obviously valuations have already become attractive, but we still want to just postpone over the next quarter or so to get some more indications on tech spending in the US.
Got that. Thank you very much, Dhiraj, for joining in. Need to slip into a very short break on that note. Before that, a quick programming note for all our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing the boundary, making an impact, shaping the future. Nominations are now open. Scan the QR code now. Submit your entry for the SME Champion Awards Season 2.